So Jeff, we know that the cloud continues to be a big way that companies are managing their data, and securing that data is hugely important. Datadog is a company that's in the middle of that. They just reported earnings. The stock is down. And you think even with the stock down, the results indicate this is a stock that's the way the business is executing, that's still worth buying.
Yeah, I don't get the market's early reaction to this one, so I'm happy to go through it with you.
Yeah, let's take a closer look at it. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. You see it on the screen, fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link. Okay, I'm going to bring it up on the screen. We're doing the recording. This is after earnings has come out. This is the first trading session. And before the market opened, the stock just absolutely plummeted. It's slowly come back. It's still down about 3%. After a pretty solid quarter and guidance, that's not bad.
When I saw the initial reaction, that the bottom of that dip you just showed, I was pretty surprised, because when I looked at all the numbers, I thought things looked pretty good. Just about everything you could possibly find in the report was heading in the right direction. So the reaction surprised me. So just real quick, like a couple headline numbers that jumped out to me. As we've seen with a lot of these companies, Jason, the top line has been slowly slowing over the past several quarters as businesses have been a little bit more careful about their spending and things like that. Actually, revenue growth ticked back up slightly to 26% year over year for Datadog. It had been 25% in Q3. So maybe this is the beginning of that trend reversing. I guess we'll have to wait and see, but it certainly didn't continue to decline, which I think is good news. But the rest of the highlight numbers are pretty impressive. The gross margin was 82.2%. That's up from 79.4% in December of 2022. So that's a pretty good increase in just a year for a company that was already had a really high gross margin, as most software companies do. Earnings per share grew 267%. The company generated $200 million in free cash flow. So all of the headline financial numbers were really impressive and nothing to complain about there.
Yeah, I want to go through a few of these too and just highlight why, like right now, what's happening with this business is so important. You mentioned gross margin. So you think about these businesses, gross margin, this is all of the dollars that they get after they sell their product or service that they can pay all their operating costs with. And margins that are that high with these very scalable businesses like Datadog, you're at a point now where it's really on the cusp of those numbers turning into much, much bigger numbers. So again, quarterly operating income of 28 million, narrow 5% operating margin, considering low 80s gross margin. That's a narrow operating margin. But a year ago, right, the numbers were negative. So we're making the tip into positive numbers on an adjusted basis. Numbers are even better. We look at the full year numbers. I think this is good because this starts to see, again, on a GAAP basis, those numbers were negative. So this fourth quarter was one of the first periods where we're starting to see that tip into positive territory. The cash flows, you mentioned that. I want to highlight that again, because they're at a point where even though they're generating negative operating results on a GAAP basis, they're generating tons of positive cash flow because of non-cash expenses like stock-based compensation for a lot of these companies continues to be a pretty big number, but there's other non-cash numbers. So the company's able to live off of its own balance sheet, right? Even as it was generating those negative operating numbers that are starting to turn positive. I want to hit the guidance really quickly because I think this is another positive story. And then we can highlight some of the things about the quality of the business that I think matter a lot, Jeff.
Yeah. My first thought when I saw the market reaction was maybe the guidance was weak, but it really wasn't. We'll focus just on the full year guidance because I think that's a little bit more interesting in terms of the overall trajectory of the business. So they're guiding for revenue for fiscal 2024 between 2.5 and 2.57 billion dollars, which shakes out to be about a 20% increase over this year. That's great. I'll take 20% every year. Again,
it's still decelerization, but it's still at a high rate while we're seeing the bottom line numbers really start to improve.
Right. Yeah. And I think this is a new-ish company to the public markets. And I think we all got spoiled when it first came IPO'd and through the pandemic when we were seeing 40, 50, 60% top line growth. I just don't think that's not sustainable. And I don't know if we'll ever get back there with Datadog, but if it can stay in the 20% range, that's fine. So I'm not disappointed by that at all. Non-GAAP operating income, there is around 9 to 11% in that range based on the guidance. Non-GAAP net earnings per share, again, growing 5 to 9%. Not knock your socks off results, but nothing to be concerned about in my mind.
Very good, very high quality guidance and results. And let's talk about the business quality a little bit here, talk about the stickiness, talk about their land and expand model where Customers start off using it in part of their business and then scale it up and add more modules and increase their spend over time.
Right. So the one thing you'll see here at the top, which is maybe the only point of concern, and I don't even know if it is because, again, this is still a very good number, is that top metric, the net dollar-based retention rate. So this is essentially, it's at 100 or mid 110s in the most previous quarter, which means for every dollar that current customers spent last year, they're spending around $1.15. And that's slowing down, as you can see. It was above 130 for a while, and then it slipped down to the 120 range, and now it's in the mid-teens. Again, if your customers are spending anything above 100% in net dollar-based retention rate year over year, you're selling more products to your current customers, and that's a good thing. Total customers up 18%. Customers with $1 million or more in annual recurring revenue up 25%. Customers with $100,000 or more in annual recurring revenue up 15%. And those last four metrics there, they added a new one, that bottom one, percentage of customers using 8 or more products. That's new. That's a new one that they're reporting. But if you compare any of those metrics to where they were a year or two ago, you can see that with every passing quarter, customers are buying more products. The 2+ numbers going up, the 4+ numbers going up, and so on and so forth. We talked about the top line financial numbers that you hear about when the earnings release comes out, but when you dig into the customer metrics, everything there is heading in the right direction also.
Yeah, I think the one that jumps out at me the most is actually in the middle, that customers using 4+ products, meaning they're using a pretty large number of products from Datadog, and they're pretty embedded in Datadog as a partner, managing their cloud security. It was roughly a third. The beginning of 2020 was roughly a third of customers had 4 or more modules. It's almost half now, right? That is a substantial growth. And again, you went from just under 20,000 customers to over 27,000 customers. So you have almost half of your 27,000 customers with 4 or more modules versus about a third of your less than 20,000 customers, right? So I think that's really important, is even though we've seen that retention rate slow to mid 110s, it's on a much bigger revenue number, right? So the total dollars of revenue that they're growing are still really big numbers. The percentages are smaller because, well, the whole numbers are bigger.
And I think it's important to remember too, no company goes up and to the right on every metric forever. That you, even for a great company like Datadog, you're going to see in its results the impacts of the macroeconomic environment. So right now, businesses are in a place where they're focusing a little bit more on profitability. Interest rates are higher. Money's not free anymore. You're going to see that impact the best businesses. But in my mind, with this land and expand model, it doesn't seem like they're losing customers overall. What I'm assuming is you're getting a customer that maybe a year ago or 2 years ago might have bumped up from 4 products to 6, but for right now is staying at 4. Or maybe dropping from 4 to 2 in the short term, and maybe we'll add those back. Right? I can imagine a scenario where businesses are adding or staying where they are just based on the macroeconomic environment. So keeping those customers, keeping them growing at a slower rate is great because you're still going to grow the overall base. And then when inevitably we hit a great economic environment and companies are back in spend mode, you're going to see these customers add modules, and you're going to see the results on that end of the spectrum as well.